Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Qinhuangdao Port Co. Limited annual report. Qinhuangdao Port Co. Limited offers a wide range of integrated port services to cater to the diverse needs of its clients. At the core of its operations are stevedoring, stacking, warehousing, transportation, and logistics services, which enable the handling of various types of cargoes such as coal, metal ores, oil, liquefied chemicals, containers, and general goods. In addition to these primary services, the company provides ancillary port services like tallying and transshipping. It also offers value-added services that include tallying, coal blending, tariff-free warehouse, and export supervisory warehouse services, as well as loading and unloading services. Furthermore, Qinhuangdao Port Co. Limited engages in port investment activities and leases harbor facilities, equipment, and machinery for use by its clients. The company's comprehensive service portfolio is complemented by specialized services such as power and electrical engineering, labor dispatch, and repair of harbor facilities and equipment. With a rich history dating back to 1898, Qinhuangdao Port Co. Limited has established itself as a leading port operator in mainland China, serving the needs of its clients through its extensive range of integrated port services. Qinhuangdao Port Co. Limited market capitalization of 19 billion is materially smaller than most of its industry peers of roughly 41 billion. Qinhuangdao Port Co. Limited trades at a higher price-to-earnings ratio of 7 times and a lower price-to-book ratio of 0.58 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced. Investors should evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The balance sheet appears very conservative, with liabilities representing only 27% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 3.7%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in the company's operations can be identified through a thorough analysis of various factors. On the growth side, the increase in volume and revenue of the coal business has been a significant contributor to revenue growth. Additionally, improvements in general cargoes handling services such as throughput increases, adoption of flexible business policies, and enhancements in grain storage and transshipment capacity have also contributed to growth. Furthermore, expanding incremental volumes from outside the province through iron ore business, enhancing intermodal efficiency and service capabilities, dynamically adjusting commercial policies, utilizing return trip capacity, and securing import grain business have all played a role in driving revenue growth. Establishing Qinhuangdao Port as a primary hub for heavy-lift cargo has also been a significant contributor. On the decline side, steady decline in coal market supply and demand, limited potential for increased coal production due to safety requirements and policy initiatives, and decreased port handling fees have all contributed to revenue decline. Additionally, decreases in container service, liquefied cargo service, and others category have also led to a decline in revenue. The net income of a company experienced significant growth between 2024 and 2025. The net income increased by $83,332,353, marking an 11.3% year-on-year increase. This substantial rise in net income is also reflected in the profit margins, which saw notable improvements across various categories. Operating profit margin rose by 0.9 percentage points to 28.6%, while total profit margin increased by 0.3 percentage points to 29.1%. The most significant improvement was seen in gross profit margin, which jumped by 3.58 percentage points to 41.67%. Net profit margin also experienced a notable increase of 1 percentage point to 23.9%. The overall trend suggests that the company's financial performance improved significantly between 2024 and 2025. The increases in net income and profit margins can be attributed to various factors, including efficient cost management, effective revenue generation strategies, or a combination of both. The financial health of a company can be determined by its ability to generate positive operating cash flow. This indicates that the company has sufficient funds to cover its operational expenses, invest in growth initiatives, and pay off debts without relying on external financing sources. According to the provided information, the company is indeed generating positive operating cash flow. This is confirmed on page 12 and page 30 of the financial reports. The generation of positive operating cash flow suggests that the company's operations are profitable and efficient, allowing it to maintain a strong financial position. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, total liabilities decreased by $1.2 billion, indicating a substantial reduction in the company's debt burden. Furthermore, unsecured borrowings also saw a notable decrease from RMB 4.9 billion to RMB 3.4 billion. In terms of interest expenses, there has been a significant decline. Interest expense decreased from $172 million to $111 million, representing a drop of over $60 million. Additionally, interest expenses decreased by 33% year-on-year, indicating a substantial reduction in the company's financial costs. The total financial cost also saw a remarkable decrease of 73%, from RMB 56.6 million to RMB 15.3 million. Overall, these changes suggest that the company has made significant strides in reducing its debt level and interest expenses, resulting in lower financial costs. The company has a history of paying dividends to its shareholders. In fact, it has made significant payments in this regard. According to the provided summary, the total cash dividend amount paid out was RMB 642,552,380. This indicates that the company has been committed to rewarding its investors through regular dividend payouts. Furthermore, the dividend per share was set at RM tax inclusive, for every 10 shares. This suggests a clear policy of distributing profits among shareholders in a fair and transparent manner. While there is no information on share buybacks, it is evident that the company has prioritized dividend payments as a means of returning value to its investors. That concludes the financial summary for Qinhuangdao Port Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.